The euro is in crisis. It has fallen 20% against the dollar since the beginning of December. I do believe that the euro will survive, although the composition of the eurozone area could change. One or two countries may drop out of the eurozone as a result of this crisis, but I think the euro itself will remain. The headline of the crisis is the fiscal problem in many of the vulnerable countries. But in fact, the deeper roots of the crisis go back to the establishment of the euro and the loss of competitiveness that has ensued in many of these economies. The loss of competitiveness was in part a result of a big confidence boost and a demand boom that raised wages in excess of productivity in the vulnerable countries, and partly a result of rigid labor markets in some of these countries. Another important element in the loss of competitiveness was the fact that following its reunification, Germany did a magnificent job of restructuring its economy, increasing productivity, and without increasing wages very much. Europe is getting to the point where it is pushing the right buttons to deal with the very deep crisis of the euro. Unfortunately, it took too long getting there. And as a result of this, the cost is going to be significantly higher. This is most clearly evident in the case of Greece, where assembling a rescue package, including the IMF contribution, took too long and was too conditioned, I would say, by very divisive politics in Germany, Greece particularly, which I think delayed and reduced the incentive, if you like, on the policymakers to act in a more decisive way. But I think they are getting there. I think the most recent package, 750 billion euros, is obviously a very substantive reaction, and the decision by the European Central Bank to resume its liquidity operations and even to purchase government bonds has also been a step in the right direction, albeit a very controversial one. And I think this has helped stem the panic. We're still in a very difficult situation, but I think by and large we are stemming the panic. I think Germany has not provided effective leadership so far. It was Germany's reluctance to intervene in Greece that delayed the package. The decision to purchase government bonds, although on the part of the European Central Bank, although I think it was an important element in stemming the panic, was resisted by representatives of the Bundesbank. And when Germany has decided to act, it did so unilaterally, as in the case of the banning of naked short selling that we saw recently. And so this slowness in reacting and this recalcitrance is really a reflection of deep political divisions within Germany, a strong sense, and understandable in many respects, on the part of the German public, that they did the hard work, that they did become competitive, they did do the restructuring, they did contain spending, and now they're having to pay the bill for profligate countries in the European periphery. Unfortunately, as I tried to say before, this is only one part of the story. Some countries, like Spain or Ireland, actually have smaller government debts than Germany has. But the problem is that these countries are suffering from the same competitiveness loss that they share with Greece, Italy, others. So the problems are much deeper, and the politics, I think, has not adequately caught up with the realities. The adjustment measures that Greece has agreed to and has already began to enact in quite an aggressive way are very far-reaching. Some have described them as brutal adjustment measures. There is a very significant reduction in wages in the government sector in Greece. Perhaps that's the clearest example. There are changes to their pension laws. There are a number of structural reforms that have been agreed. So I think Greece is reacting quite aggressively as part of the rescue package. However, I am among those who believes that in the end, even under a successful adjustment of Greece, their debt to GDP is going to be so large, estimated at somewhere near 150% of GDP, even if the adjustment works, that at some point we will need to consider a restructuring or to use a more direct word, a partial default of on Greek debt, or alternatively, some means may be found of forgiving Greek debt without them outright defaulting. Portugal is definitely at risk. Portugal has a very high debt, not as high as that of Greece. It has a very large fiscal deficit. And most importantly, Portugal has been growing extremely slowly, at just about the slowest rate of growth in the Eurozone for many years. So the likelihood that it can grow itself out of debt seems very, very low. It has many of the same loss of competitiveness characteristics that we observe in the other vulnerable countries. At the same time, I think the Portuguese government is clearly moving to take some significant corrective action. So this remains an open question. It's a risk, but remains an open question. Spain is, in fact, in a sense, the most worrisome situation at the moment. Its imbalances are actually not as extreme by any stretch as those of Greece. Certainly, its debt to GDP ratio is still relatively low, although it is rising very rapidly. Spain is a special concern because the total debt of Spain is over twice that of Greece. I mean, this is a significant economy. And the greatest vulnerability of Spain is that it has lost competitiveness along with all the others, but at the same time, its economy has become far too dependent on what I would call the non-tradable sector, the sector that is sheltered from international competition, housing, services, call them restaurants, bars, whatever. I mean, activities that are generally non-tradable have become too big a part of the economy, and not enough of the economy is oriented towards external markets. For these reasons, the collapse of the housing bubble and of domestic demand in Spain raises a profound question about the speed at which Spain can emerge from these problems. It has, in other words, the same sorts of growth constraints that we've been talking about with respect to Portugal and with respect to Greece. If Italy gets into trouble, we have truly a world-class problem, because, as I said, Spain's debt is twice that of Greece in terms of absolute amount of money outstanding. Italy's debt is 3 times that of Spain. And now we're talking about debt in the region of 1.5 to 2 trillion euros. This is real money. Now, Italy is a mixed case, because on the one hand, it has clearly seen very large losses in competitiveness, like the other vulnerable countries, and at the same time, its debt to GDP ratio is very high. It's about as high as that of Greece. On the other hand, in recent years at least, Italy has seemed to get a handle on its fiscal deficit. And its fiscal deficit is modest compared to other countries in Europe. It's about half, let's say, the British deficit, or half the Spanish deficit. And it appears that the Italian government does have control over its finances. That's what it has demonstrated in recent years. However, I would not exclude the possibility that particularly should the crisis spread to Spain in a major way, that the markets will become very nervous about Italy. And remember that a lot of this is about market psychology. You cannot just boil it down to arithmetic. Potentially, this has an important impact on the United States. There are 2 main sets of impacts. The first set of impact is through trade. Europe is a very important trading partner of the United States. It is the world's largest trading bloc. If Europe does not grow, and furthermore, if the euro is extremely weak, it's more difficult for the United States to export its way out of its problems. And as you know, there is an objective, a stated objective, on the part of the Obama administration to double exports in 5 years, to become less reliant on domestic demand, more reliant on world demand. But the more important risk to the United States comes through the financial angle. And in one word, the concern is about fear. Will we have a return of the credit crunch that sank the global economy 18 months ago, because banks become very concerned about lending to each other, or banks lending at all, given the fact that European banks are, of course, laden with European government debt, as you would expect. After all, this was supposed to be the safest possible investment. If the European banks are under threat, then you should assume that the international banking system is under threat because of the size of Europe and because of the interconnections of financial markets. So the risks to the United States are significant, and this is why President Obama has been so often on the phone with European leaders in the course of the last month or so. What can the United States do to help fix the situation? The United States can actually do quite a lot, although it has to do it in a very discreet way, because Europeans are understandably very sensitive about the fact that this is a European problem. But the United States can support and has supported the IMF's involvement in Europe. A lot of that money that the IMF will lend would come directly or indirectly from the United States. The United States is the biggest shareholder of the International Monetary Fund. United States can reinstate and has done so swap operations through the Federal Reserve Bank to provide dollars in the event of an emergency to European countries that need it. And the United States can exercise a high degree of, I would say, persuasion. Let's call it moral suasion. It makes a big difference if the call to Zapatero to undertake very difficult reforms is coming not just from Berlin or from Paris, but it's also coming from Washington. And I think that has actually made a difference. And finally, and this is the toughest bit, the United States has to understand that the European crisis is a very deep crisis. It's a competitiveness crisis at its heart, and should accept that we're going to have a lower exchange rate for the euro for some years to come. Without that, it's going to be very difficult for Europe to pull out of its problems. So this doesn't help the United States, but this is part of the sacrifice that the United States, or the price that the United States has to pay to maintain global financial stability in the face of this massive debt crisis in Europe.